You see it before it happens. The pullback on the daily chart. That clean rejection at resistance. Volume confirming. RSI showing divergence. Every indicator screaming the same thing. This is the setup. You enter the trade. Not because your plan said to, because your brain already decided it would work, and then it doesn't. The pattern breaks, price runs the other direction, your stop gets hit, and you sit there staring at the chart, wondering how you saw everything so clearly and got it so wrong. This is the moment that destroys more accounts than blown risk management or bad strategy ever will. Because what just happened wasn't trading. It was your brain doing exactly what evolution designed it to do. Finding the pattern you wanted to find, filtering out everything that contradicted it, and convincing you that certainty existed where it never did. And the worst part? You didn't even know it was happening. Research shows that traders with stronger confirmation bias tend to exhibit greater overconfidence and trade more frequently, which directly correlates with lower profitability. This isn't about intelligence. It's about how your mind processes uncertainty when money is at stake. The pattern is devastating. The bias is confirmation bias, and it's wired so deep into human cognition that you'll do it again tomorrow. There's advice you've heard 100 times. Follow your system. Trust your analysis. Don't let emotions interfere. It sounds bulletproof, professional, the kind of wisdom that separates amateurs from serious traders, and it completely misses the point. Because the problem isn't that you don't follow your system. The problem is that confirmation bias makes you think you are following your system when you're actually rewriting it in real time to match what you want to believe. You backtest a strategy. The results look solid. 60% win rate. Risk reward makes sense. You tell yourself this is the edge, then you trade it live. A losing streak hits. 3 trades, 4 trades, 5 in a row. The strategy says wait for the next setup. But your brain says something else. It says, maybe this time is different. It says, maybe if I take this one slightly off plan, the setup that almost matches the criteria, it'll break the streak. It says, I've seen this pattern before. I know how this ends. And suddenly you're not trading your system anymore. You're trading a version of your system that your brain has quietly modified to feel safer, to feel more in control, to confirm what you already believe should happen. Confirmation bias leads traders to seek information that aligns with their existing beliefs while disregarding contradictory evidence, creating an echo chamber where losing strategies feel validated and good strategies get abandoned at the worst possible time. Because what destroys traders isn't the idea. It's what your brain does with it when pressure builds and certainty starts to crack. You wake up before the market opens, coffee, charts, the routine. You've done your prep. You know what you're looking for. Clean price action, volume confirmation. Wait for your entry criteria. The market opens, price moves, but not quite the way you expected. It hesitates where it should have broken out, pulls back where it should have continued, and now you're watching something that's close to your setup but not exactly it. 90% of you says, wait, this isn't the trade, but 10% says, this could still work. And that 10% is loud. It reminds you of the last time you hesitated and missed a runner. It shows you the one indicator that still looks bullish. It whispers that the market is just being tricky, that you're smart enough to see through the noise. You enter. The trade feels right for about 4 minutes. Then it doesn't. Then it's underwater, not by much. Just enough to hurt. Now you're stuck in a new decision. Cut it, hold it, add to it. Your brain shifts. The part of you that entered the trade starts looking for reasons it'll work. You ignore the divergence forming on the lower time frame. You dismiss the volume dropping off. You tell yourself this is just a retest. That price is building energy for the move you anticipated. You're not analyzing the market anymore. You're defending a decision you already made. And this is where the damage compounds, because this moment, this tiny deviation from the plan, doesn't feel catastrophic. It feels like adaptation. It feels like experience. But it's not. It's your brain protecting itself from the discomfort of being wrong. And that protection will cost you more than the trade itself. Studies show that confirmation bias is linked to overconfidence, poor decision-making, and overtrading. This isn't personality. This is neuroscience manifesting in price action. Here's where your brain starts lying to you. And this tiny moment leads to catastrophic decisions later. Meet Alex. 28, former software engineer. Left the corporate job 8 months ago to trade full-time. Smart. Disciplined, at least on paper. Keeps a journal. Reviews his trades. Alex has a system. Trend following. He waits for pullbacks in strong trends. Enters on confirmation. Holds until momentum fades. It's clean. It backtests well. It should work. Monday morning. The market gaps up. Clean trend. Alex watches for the pullback. It comes. But it doesn't quite hit his entry level. It stops 10 points above. Price starts to move again. Alex hesitates. He knows the rule. Wait for your level. But his brain is already showing him something else. It's showing him the last 3 times he waited and missed. It's showing him that the trend is strong, that volume is there, that 10 points won't matter if this thing runs 50. He enters, not at his level. Close enough, he tells himself. The trade moves 5 points in his favor. He feels validated. Then it reverses, slowly at first. Then faster. His stop is 15 points away. Price is now 12 points against him. He should exit. The trade broke its thesis. But Alex doesn't see it that way. What Alex sees is, it's just a retest. It'll bounce. What Alex sees is, I was right about the trend. This is noise. What Alex sees is, if I cut this now and it turns around, I'll have stopped myself out for nothing. His stop gets hit. He takes the loss. It stings. Not because it was big, but because he knew, some part of him knew, that he shouldn't have taken it in the first place. So now Alex is in a different state. Not calm, not neutral, something else. He opens his journal. He writes, entry was slightly early, but thesis was correct. Stop was too tight. And in that moment, confirmation bias completes its loop. Alex has just rewritten what happened. He hasn't learned from the mistake. He's learned to justify it. The next trade comes an hour later. Another setup, this one cleaner, but Alex is still thinking about the last one. Still feeling the sting. Still wanting to prove he was right. He takes this trade bigger, not because the setup is better, because he needs it to work. And in that moment, everything inside him quietly breaks. When you lose money, your brain doesn't just register disappointment, it registers threat. Cortisol floods your system. Research on traders under stress shows long hours and competitive pressure lead to significant shifts in hormonal regulation, particularly elevated cortisol levels. Cortisol isn't just a stress hormone, it's a survival mechanism. And when it spikes, it doesn't care about your trading plan. It cares about preventing future pain. This is where the amygdala takes over. Under stress, the amygdala activates pathways that impair prefrontal cortex function, shifting control from thoughtful decision-making to rapid emotional responses. The part of your brain that does math, that evaluates probability, that sticks to systems, it goes offline. What comes online instead is pattern recognition, but not the good kind, the desperate kind. Your brain starts scanning for anything that looks like a winner, anything that feels like control. It stops asking, does this meet my criteria? And starts asking, can I make this work? This is reward prediction error. Your brain expected a win, it got a loss. Now it's recalibrating, searching for any signal that the next trade will restore what was taken. But here's the problem. The signal it finds isn't real edge. It's confirmation bias dressed up as analysis. You see a chart. Your brain highlights the indicator that confirms your thesis. It dims the one that contradicts it, not consciously, automatically, and you genuinely believe you're being objective. High levels of stress-induced catecholamine release cause the brain to switch from reflective regulation by the prefrontal cortex to reflexive regulation by the amygdala. This isn't you being weak. This is your nervous system doing exactly what evolution designed it to do, just at the worst possible time. This is why you can backtest like a genius and trade like a beginner. Now add repetition. You take another trade based on faulty pattern recognition. It loses. Cortisol spikes again. The cycle deepens. This is learned helplessness. Your brain starts to believe that no matter what you do, the outcome is random. So it stops trying to be systematic. It starts trying to be lucky. And now you're not managing risk. You're managing emotion. You're not executing a strategy. You're executing hope. Your brain isn't malfunctioning. It's doing exactly what evolution designed, just at the worst possible time. The loss from the morning still sits in Alex's mind. Not as data, as unfinished business. He tells himself he's moved on. He hasn't. Afternoon session opens. Another setup appears. This one is different. Weaker trend. Less volume. His system says pass, but Alex doesn't pass. Because his brain isn't asking, is this a good trade? It's asking, can this trade fix what happened this morning? He enters. Position size slightly bigger than normal. Not reckless. Just enough to recover the loss plus a little extra. The trade moves against him immediately. 5 points. 10 points. He holds. His internal dialogue shifts. It's no longer. This was a mistake. This is a shakeout. They're hunting stops. It'll reverse. It doesn't reverse. It accelerates. Now he's 20 points down. His daily loss limit is approaching. He should cut. He doesn't. Because cutting now would mean the morning loss and this loss together. And that would mean today was a failure, and Alex doesn't fail. So he holds. He watches. He narrows his focus to the one time frame that still shows a glimmer of hope. He ignores the higher time frame breakdown. He ignores the volume spike against him. He's not trading anymore. He's bargaining with probability. The stop finally gets hit. Or maybe he cuts it manually when the pain becomes unbearable. It doesn't matter. What matters is what happens next. Alex closes his platform. He doesn't journal this one. He doesn't want to see it in writing. He tells himself he'll come back tomorrow with a clear head, that this was an anomaly, that the strategy still works. But something has shifted. Some quiet part of him knows he's lying, and that knowledge will sit in his chest the next time he looks at a chart. This isn't trading anymore. It's survival. Now consider another trader. Call her Maya. Maya has the same account size as Alex, the same strategy on paper, the same market conditions. But when you watch Maya trade, something is different. Alex sees 10 setups a day. Maya sees 2. Alex enters when price is close enough to his level. Maya waits for exact confirmation. Alex adjusts his stop when a trade moves against him, telling himself he's giving it room. Maya never touches her stop once it's set. When Alex has a losing day, he reviews his trades looking for what he missed, what he could have seen, how he can avoid it next time. When Maya has a losing day, she reviews her trades looking for whether she followed her process. Alex's equity curve looks like a heartbeat monitor. Spikes up, crashes down, recovers, crashes again. The net result over 3 months? Slightly negative. Maya's equity curve looks like stairs. Small steps up, occasional steps down. But the trajectory is unmistakably positive. Same strategy, different execution. And the difference has nothing to do with technical skill. Alex is trading his beliefs about what the market should do. Maya is trading what the market is actually doing. Alex sees a chart and his brain immediately generates a narrative. This is going to break out. I've seen this before. This is my edge. Then he looks for evidence to support it. Maya sees a chart and asks, does this match my criteria? Yes or no? If yes, she trades it. If no, she doesn't. No story, no conviction, just process. When Alex is wrong, he feels it. It disrupts his confidence, makes him question his ability, makes the next trade harder to take, or makes him overtrade to prove he's still got it. When Maya is wrong, she records it. Checks if she followed the plan. If she did, she moves on. If she didn't, she notes why and adjusts her process. Alex's win rate is slightly higher than Maya's, 58% versus Maya's 52%. But Alex's average loss is twice the size of his average win. Maya's average win is 2.5 times her average loss. Research shows that traders tend to sell winners at a significantly higher rate than losers, with studies indicating this behavior leads to underperformance. This isn't strategy. This is psychology playing out in position management. The market doesn't care who's smarter. It doesn't care who's worked harder. It cares who can remain neutral when their ego says they're right. And that's where Alex and Maya split into different universes. On paper, these two traders look identical. Inside their brains, they live on different planets. Let's talk about something most traders never consider. The shape of their suffering. Not the size of their losses. The shape. Your equity curve isn't just a record of profit and loss. It's a record of neurochemical stability. Alex's curve spikes and crashes. Every spike floods his system with dopamine. Every crash floods it with cortisol. His brain is on a roller coaster, and roller coasters wear you down. This is variance stress. Not the math kind, the biological kind. When you win, your brain releases dopamine. That feels good. But if wins are inconsistent, if they're separated by long stretches of losses, your brain starts treating each win as a lottery ticket instead of the result of a process. Now, you're not building confidence, you're building dependency. You need the win to feel normal, and when it doesn't come, your system crashes harder. Studies of trader performance show that between 70 and 90% lose money consistently, and the psychological mechanisms behind this are as predictable as the math. Maya's curve doesn't spike, it steps. Smaller wins, more frequent. Her brain gets steady dopamine feedback, not huge hits, just consistent reinforcement that the process works. This is why she can handle a losing streak without spiraling. Her nervous system isn't dependent on the next win to restore balance. It's already balanced. Alex's strategy might be mathematically profitable, but if he can't emotionally survive the drawdown, the math doesn't matter. This is the ulcer index translated into psychology. It's not just about max drawdown, it's about how often your account is underwater, how deep, and for how long. If you're in drawdown 40% of the time, your brain is in stress mode 40% of the time, and stress mode makes terrible decisions. Maya's strategy keeps her in drawdown maybe 15% of the time. Smaller, shallower, shorter. Her brain stays in analysis mode. Alex's brain stays in survival mode. The strategy you can't emotionally stick with is mathematically worthless. Here's what professional traders actually do that retail traders miss entirely. They don't worship win rate. They worship psychological sustainability. Institutional traders, the ones managing real capital for decades, that don't optimize for the highest theoretical return. They optimize for the strategy they can execute without breaking. High-frequency traders use systems with 70–80% win rates, not because it's the only way to make money, but because frequent small wins create stable neurochemistry. The traders don't burn out, the system survives. Prop firms don't give traders capital based on back-tested returns. They give it based on consistency. They want to see someone who can follow the same process through wins and losses without deviating. Why? Because they know what retail traders refuse to accept. Most traders don't fail because their strategy is bad. They fail because they can't execute the strategy when their nervous system is screaming. Position sizing isn't about risk-reward ratios. It's about sleep. If you're checking your phone at 2 a.m. to see if your position moved, your size is wrong, not mathematically, biologically. Professionals design for boring. Retail traders design for exciting. And exciting kills accounts. The edge isn't in finding the perfect entry. The edge is in building a system your brain can tolerate for years. Retail traders chase what looks smart. Professionals chase what keeps them sane. So what does a better approach actually look like? Not a list of tips, not motivation. A structure that protects you from yourself. Maya's system is built around one principle: eliminate interpretation. Every Sunday, she writes down her trade criteria: exact price levels, exact volume thresholds, exact risk parameters. No room for "it looks good" or "close enough." When the market opens, she doesn't watch every tick. She sets alerts at her levels. When the alert hits, she checks. Does it meet all criteria? Yes or no? If yes, she enters. If no, she closes the chart. No stories, no conviction, no attachment. After every trade, win or lose, she opens a journal. Not to analyze the market, to analyze herself. Did I follow the plan? Yes or no? If yes and it worked, I executed well. The process is sound. If yes and it failed, I executed well. This is variance. The process is sound. If no, why? What was I feeling? What narrative did my brain create? The journal isn't tracking trades. It's tracking confirmation bias in real time. When she spots a pattern, I tend to take trades off plan when I'm recovering from a loss. She builds a rule. No trades within 2 hours of a stopped trade. Her system evolves, but not based on what the market did. Based on what her brain did. This creates emotional stability. Because she's not trying to predict the market. She's not trying to be right. She's trying to be consistent. And consistency, over time, is the only edge that compounds. Maya doesn't trust her gut. She trusts her process. Because she knows her gut is running on a brain that's optimized for survival in prehistoric Africa, not for probabilistic decision-making in leveraged markets. This approach feels mechanical. That's the point. Because the moment trading feels thrilling, confirmation bias is in control. Here are the questions you need to sit with. Alone. Honestly. What kind of equity curve can you actually survive? Not the one you want. Not the one that makes the most money on paper. The one you can stick to when you're down 20% and every instinct says abandon ship. Which part of your trading isn't strategy, but emotion? Where do you deviate from your plan? Is it after losses? Is it when you see other traders posting wins? Is it when the market moves without you? Are you building a system your nervous system can actually tolerate? Or are you building a system for the version of yourself that only exists in backtests and before the pressure hits? Is trading helping you? Or giving you a place to run from something else? Are you here to solve a problem in your life by making money? Because if you are, your brain will trade emotionally until that problem is solved another way. And the market doesn't care about your problems. These aren't rhetorical. These are diagnostic. If you can't answer them, you're not trading. You're gambling with a strategy attached. Here's the truth no one wants to hear. Confirmation bias will never go away. It's not a bug, it's a feature. Your brain will always try to find patterns, to confirm beliefs, to protect you from the pain of being wrong. You can't delete it, but you can design around it. You can build a system that removes interpretation, that removes discretion, that makes execution binary instead of subjective. You can journal not your trades, but your thinking. Track where your brain lies to you, because it will. Every day. You can shrink your position size until losses don't trigger cortisol spikes, until you can take a stop trade and feel nothing. Because if you feel something, your size is too big for your nervous system. And you can accept that the traders who survive aren't the ones with the best strategy. They're the ones who understand themselves well enough to know when they're about to deviate and don't. Most traders spend years looking for the perfect entry. The real edge is knowing when not to take one. Stop building strategies for the trader you wish you were. Build them for the human who actually shows up when money is on the line. In trading, survival isn't the first skill. It's the only skill. Your next breakthrough won't come from a better entry, but a better understanding of yourself.